Howdy, who all my stock market gamblers. Welcome today. It's Monday. Stock market's back open. What do we got going on? Well, we got a rally going. Dow's up about 600. Nasdaq's up about 200. So this is a rally that is a relief rally, right? We had a terrible September. September was the worst September in about 20 years. It was down 9% just for the month of September. Now, here's the good news. The good news is after you have a September that is down 7% or more, typically October is an up month. All right, now October on the other side of the coin is also a month where you do get the stock market crashes, where you do get the Black Mondays. So it's going to be a tug of war right now between the bulls and the bears. We're getting a little bit of a relief rally today. Now, do I think that that was the bottom that we just saw? I actually do not. I still think that the bottom is not in yet, but I do think that this relief rally could last, well, it could just be one day, could be a couple of days, but relief rallies sometimes are very strong. We can bounce right back up to the 10-day moving average, the 20-day, the 50-day. We're below all the moving averages right now. I mean, we've had a terrible month of September, and we've had 3 quarters of straight down, right? I mean, we have wiped out $36 trillion. $36 trillion in the global markets of the stocks and the bond market. Now, it's really unusual right now that we're getting both stocks down and bonds down at the same time. That would tell you that something is broken in the market. And we could get a financial crisis coming in the next 3 to 6 months. Very possible. Something is broken. Something's not right when you got stocks and bonds going down at the same time. This is very unusual. Now, to give you an idea, we've lost $36 trillion, right? So far, just since this year, the beginning of this year, January till now, down $36 trillion. Now, in the great financial crisis, we only lost $24 trillion. We're already 150% of the great financial crisis. But of course, assets are more inflated now, so that number doesn't mean quite as much. But $36 trillion wiped out. That's a lot. We're getting the relief rally. We'll see how it plays out. All right. So over the weekend, I listen to more of the economic news. I listen to other podcasts. I love this stuff. I can't get enough of it. I love listening to the economic news. And I was listening to this economist, right? His name was Lawrence Kotlikoff. Lawrence Kotlikoff, he's an award-winning economist, and he's a professor at Boston University. All right. Now, I'm in favor of everybody having differences of opinions, but his opinion was much different than my opinion. All right, so he thinks that this is a really good time to buy a home. Now, the reason he believes that is he believes that 7% mortgages, he believes that is extremely cheap. That is very cheap money because we got inflation running, let's just call it 9%, right around 9%, and this means that the mortgage rate is actually negative 2% in real terms. You got the 7% mortgage minus the 9% inflation, so it's a negative 2% mortgage rate. And that would mean it's a great time to buy a home. This guy should be a real estate agent because it's always a great time to buy a home. Now, he had some very interesting views, and it was a very difficult interview for me to watch being an economist when we're so extreme, right? Now, he thinks the Federal Reserve came in and they saved us in 2008. They saved us by printing all of this money and reducing interest rates to zero. Well, I have a different opinion. I think that they just did not let the market flush out in 2008. They propped it up artificially for the last 14 years. Now, that's, it's not sustainable. An artificial market is a fake market, and I think that they propped it up. He thinks they saved us, and he thinks they're saving us now. Now, the Federal Reserve, they themselves admit that they want to bring the housing market back to affordable levels. Now, what's kind of funny is they think that they're the ones that are going to bring it back to affordable levels. Well, when everything crashes, it will be affordable again, but the Federal Reserve is actually responsible for the bubble that the housing market's in. So we're expecting them to fix the housing market? I don't think so, but this is what this professor's telling me. Now, he also believes He also believes that homeowners are not affected by mortgage rates once they have bought their house. The mortgage rates doesn't affect them anymore. Now, he says it's just all psychological. Now, look, if your house goes down by 50%, that's not psychological. You become poor. But he thinks it's just psychological and that you just feel poor because you still have the same house, right? The house didn't change. Your payment didn't change if you're locked into a fixed rate. So it's just psychological that you feel poor. Well, we could not be at more extremes. And I'm going to try to demonstrate to Professor Kotlikoff how wrong he is. Okay. So this is what I'm going to say. Let's take the average price home, and we're going to take a city called Denver, Colorado. Okay, now if you had bought a house in Denver, Colorado, when the average price home, I'm going to use rough numbers, right around $200,000. Now this is 10 years ago, right? 10 years ago, the average price home in Denver was about $200,000. And now if you put 5% down, that'd be, $10,000 down, right? Okay, and your mortgage payment, let's call the interest rates back then about 3.5%. So your mortgage payment would be with insurance and taxes, all right, just a little bit over $1,000. So you have a $200,000 house, $10,000 down, and you have a mortgage payment of about $1,000. Now, inflation back then was at 2%, right? It was running about 2%, but yet rates were on the mortgages were about 3.5%. So you were having a positive real rate. You have about 1.5% on that mortgage, according to Professor Kotlikoff. Now, back then, the average household income in Denver was about $50,000. All right. So let's move forward 10 years to 2022. Now, the average price home now in Denver runs, well, roughly about $550,000, just round numbers. Okay, $550,000. Now, you put 5% down on that. Well, okay, yeah, what is that? You got about $28,000 down payment. So it used to be $10,000. Now you got to come up with $28,000. And that's only at 5% down. If you're putting 20% down, it's a lot of money. But I'm just going to go with 5% down. So back 10 years ago, you could put $10,000 down. Now you got to put $28,000 down. All right. But your monthly payment on this $550,000 house is mortgages at 7%. So your monthly payment on this $550,000 house with insurance and taxes and all that's running about $4,500 a month, about $4,500 a month. Now inflation right now is at 9%, right thereabouts. I mean, it's really a lot more than that. It's really up around 15%, and I'll explain that in a second. But okay, so 9% inflation, 7% mortgages, so it's a negative 2% real interest rate on the mortgage. So Professor Kotlikoff, he thinks that this is a great time to buy a house because he believes, and this is where we do agree, he believes that mortgage rates are going to go higher. They're going to get into a real number. So inflation at 9%, he thinks that the mortgage rates will go above 9%. And I believe he's correct on that. I believe this time next year will be about 10 or 12%. We're sitting around 7% right now. But look at the difference. Is it a good time to buy that house now, or was it a good time to buy it in 2012? Well, I think 2012 was a much better time to buy it, but we had positive real rates in the mortgage. And now we have a negative real rate in the mortgage, and I think it's a terrible time to buy. Look at now, the household income went from $50,000 in 2012 to $70,000 now. Okay, so it went up $20,000 for the year. But your monthly mortgage payment on the exact same house went from $1,000 roughly to $4,500. All right, so that's $3,500 more a month, which is about $40,000 more a year. But your income only went up $20,000 more a year for the household average income, right? Well, this is the bubble that the Federal Reserve has created. We're definitely in a bubble, and this is not sustainable. That's why I believe that the housing market is going to come down. It's going to come down a lot. It's going to come down by about 50%. Now, maybe only 40% in your area and maybe 60% in another area. But it's going to come down. Now, I know a lot of people don't believe this. Professor Kotlikoff, he doesn't believe this at all. And he says, don't worry if it comes down. It's only psychological. You're not really poor because you still own the same house. Yes, you still own the same house, but that house is now underwater. You cannot sell that house. You cannot refinance that house. You cannot even get a HELOC, a home equity line of credit against that house, because that house is now worth half of what it used to be worth. This is where me and the professor, we disagree. Now, a lot of people write in the comments they don't agree with my opinions, and that's perfectly fine. I have no problem with that, and I don't even have a problem with Professor Kotlikoff. I'm just wondering what was the award. He's an economist that's a very prized. He's the award winner, but I just do not agree with him. And look at these are people that pay tens of thousands of dollars to send their kid to Boston University, and this is what they're getting taught. Now, I could go on and on about this topic. Look at you parents. You've got to realize what they're teaching your kids, and I'm talking not in the college level. I'm talking in the high school level. Look at, they're teaching your kids that socialism is the answer, that free markets are the problem. They think that capitalism got us into this mess. Capitalism, the free market capitalism, is not what got us into this mess. Look at the printing of money and spending money we don't have is what got us into this mess. The debt crisis is here, but socialism is not the answer. And I went off on a tangent here, but that's what they're teaching your kids in high school right now. My old high school economics teacher, he's almost 80 years old. God bless him. He's a great man, but he is going back and volunteering his time to stay after school to meet with anyone that wants to learn about free market capitalism, because he sees that they're teaching socialism as the answer in the school systems. I get so frustrated with this. Free market capitalism works, socialism. I want all of our kids to learn about it all. I want them to teach them about socialism and teach them that every country that's tried that has failed. Teach them about the actual free market capitalism, not this crony capitalism that we have right now. Look, I may have got off on a little bit of a tangent. I didn't mean to go there. It's just that I'm shocked that this professor is an award winner at Boston University by saying that mortgage rates are so low right now that it's really going to be a good time to buy a house. And you don't want to miss out, right? Because the mortgage rates are going much higher. You want to get in there and buy now before the mortgage rate goes up. Well, once again, that's a fallacy. Look, as the mortgage rates go up, the house comes down. You don't want to lock in this low mortgage rate. Even if they go to 15%, you do not want to lock in a mortgage rate now, because that house is coming down 50%. It's coming down. And look, when the houses go down 50%, there's big problems. Yeah, okay, I'll give you the plus. Maybe the property taxes will come down. Rarely ever do. You usually have to petition for that to actually happen. But when the house gets dropped by 50%, you can't refinance, you can't sell it, you're underwater, you have a huge problem, and it's not a good thing. But they go, oh, Mike, but we got lucky. We got locked into that 7% mortgage rate. No. I got carried away today. It's Monday. If you like this stuff, give me the thumbs up. Get out there, everybody. Have a great night. Hit that subscribe button. I want to talk some more to you. This is an exciting week. We got a lot of volatility. Right now, we're getting that little relief rally going. But maybe, every time we've gotten the one-day relief rallies, that's always come back the next day. We'll see what happens. I'm Tall Mike. Bye-bye now.